Welcome back to the deep dive. It is Saturday, January 31st, 2026. Today we are shifting gears a bit. We usually spend our time up in the clouds, looking at abstract tech trends or macroeconomics, but today we're getting our hands dirty.
We are.
We're looking at the concrete, the steel, and the literal dirt of the commercial real estate market.
I like it.
We have the commercial investment opportunities of the week from Eureka Business Group, curated by Joseph Goslin.
The fascinating stack this week. And, the mistake most people make when they see a list like this, all these flyers for shopping centers, medical offices, raw land, is they just see a shopping list. They look at the price, maybe the location, and then they just move on.
Right.
But if you actually know how to read these listings, they're less of a shopping list and more of a masterclass in reading the tea leaves of the entire economy.
That is exactly the mission for this deep dive. We aren't here to buy a building today.
Well, not unless you have a few million burning a hole in your pocket.
Right. We're here to look at these specific listings to understand what the smart money is actually doing right now. We want to know what investors are scared of, what they're valuing, and how they're hedging against things like inflation.
Precisely. These listings, they tell a story. When you see a portfolio that's backed by the state of Texas, or a massive sporting goods store renewing its lease, or a sealed bid for land, those are signals. They tell us about risk appetites, about where people think interest rates are going, and about the future of physical retail itself.
And the variety in this stack from Eureka is honestly wild. We've got everything from a building selling for less than its tax assessment.
Yes.
Which we need to talk about because that sounds like a glitch in the matrix.
It really does.
All the way to trophy assets worth over $10 million. So let's start at the ground floor, the entry level.
The sub-$2 million market. This is where a lot of people get their start.
Right. And I think there's this huge misconception that you need to be, a private equity fund or a billionaire to buy commercial real estate.
For sure.
But looking at this first section, that is clearly not the case. We have a 2,900 square foot medical office space. It's 2 combined units, but the real headline here is the price. It says it's selling below the county assessed value.
That is the immediate hook.
So walk me through that because, in residential real estate, if a house is selling below tax value,
Right.
it usually means something is, terribly wrong with it.
The foundation's cracked, it's haunted.
Exactly. Is that what's happening here, or is this some kind of arbitrage opportunity?
It's rarely a glitch or a disaster, though. You always have to do your due diligence.
Of course.
It's usually a strong signal of motivation. You have to remember, county tax assessments are backward-looking. They're looking at what happened last year or the year before.
Okay.
The market is forward-looking. So if a property is listed below that assessment, it tells you the seller needs liquidity now.
They can't wait.
They are not willing to wait for the market to catch up to the tax man. But there's a second layer to the specific listing that really explains why it might be a deal for a new investor.
The notes mention owner financing available.
That's the critical piece. That's the aha moment for this whole listing. In the current lending environment where, banks have tightened up, rates are fluctuating, qualification is a nightmare.
Yeah, it's tough.
Now, owner financing is a game changer. The seller is effectively acting as the bank.
So instead of begging a traditional bank for a loan, filling out endless paperwork and waiting 3 months for approval, I just pay the seller monthly.
Exactly. It removes all that friction. For the seller, it moves the asset quickly because it just opens up the pool of buyers. For the buyer, say, a small business owner or a doctor who might write off a lot of expenses and look poor on paper to a bank, it allows them to bypass the institutional gatekeepers.
I see.
It turns a real estate transaction into a simple contract negotiation between two people.
So it's a fixer-upper not for the building, but for the deal itself.
That's a great way to put it. You're fixing the transaction structure, not the roof.
Okay, that makes sense. Now, staying in this entry-level bracket, there's another one that seems counterintuitive. It's a micro unit. A 756 square foot medical or office unit in West Plano.
Tiny. That is smaller than most one-bedroom apartments.
Right. And my first thought is, what can you possibly do with 700 square feet? You put a desk and a chair in there and it's full.
Right.
But then I looked at the location. It's near Willow Bend, surrounded by established retail. So why would an investor want a commercial space that small?
You have to look at the efficiency ratio. If you're a general practitioner seeing 40 patients a day, this space is useless.
You'd have people in the parking lot.
Exactly. But look at the demographics it lists. Very affluent. High household incomes. This space isn't for volume. It's for value.
So we're talking about a concierge doctor, maybe a high-end therapist, a specialized consultant.
Precisely. If you're charging, say, $500 an hour, you don't need a waiting room for 20 people because your patients don't wait.
Good point.
You need a prestigious address in the zip code where your clients live. You want low overhead renting, 700 square feet is cheap, but you want high revenue potential. It's a margin play.
So you're paying for the proximity to wealth, not just the square footage.
We're paying for the neighborhood.
Yeah.
It's a sniper approach to real estate. You don't need a shotgun, you need a laser.
I like that. Okay, rounding out this first section, there's a term I see all the time, STNL. We have a 3,615 SF Medical STNL.
Single tenant net lease.
And the listing says absolute NNN lease. Now, I know NNN means triple net, but let's be really clear for anyone who might be new to this. What exactly is the investor paying for here?
In an absolute NNN lease, the tenant pays for everything. And I mean everything.
Okay.
They pay the property taxes, they pay the building insurance, and most importantly, they pay for all the maintenance. Roof, structure, parking lot, it's all on them.
So if the HVAC blows up in July or a toilet breaks, they're not calling me.
They don't call you, they fix it. And they might send you the receipt just to prove they did it so you don't void the lease.
Wow.
This listing is categorized as recession-resistant medical with a corporate guarantee and annual rent increases. This is what we call mailbox money. You're just buying a stream of checks.
It sounds perfect. I mean, almost too perfect. I have to play devil's advocate here. What's the catch? If it's so safe, why isn't everyone just buying these and retiring?
Because the risk is binary. You have one tenant. In a multi-tenant strip mall, if one shop leaves, you still have rent coming in from the others.
You can still pay the mortgage.
You can still pay your mortgage. In an STNL deal, if that medical group goes bankrupt or decides not to renew at the end of the term, you have 100% vacancy. Instantly. You go from 0 to 0 overnight.
That makes perfect sense.
And that's why that corporate guarantee mentioned in the listing is so vital. You aren't just betting on the building. You're betting on the creditworthiness of the corporation that's signing the check. It's really a bond that's just wrapped in bricks.
Okay, let's move up to section 2. We're stepping up the complexity a bit. This is the value add versus new construction debate. And we have 2 retail centers here, roughly the same size, but they represent completely different philosophies.
This is the classic growth versus yield dilemma. Or you could say sweat equity versus checkbook equity.
Let's look at the sweat play first. It's a 5,418 square foot retail center on Colleyville Boulevard, prime location. But the listing calls it a value add play and says it's selling at a below replacement cost basis. That phrase below replacement cost, we hear it a lot. Why is that such a crucial metric?
It's your margin of safety. Replacement cost is just the math of reality. If I bought this dirt today, hired an architect, bought the steel, poured the concrete, and paid all the labor, what would it cost to build this exact building from scratch? And given the inflation in materials and labor recently, that number is historically high.
So if this building is selling for, say, $200 a square foot, but it costs $300 a square foot to build new,
then you're buying the asset at a discount to its intrinsic physical value. Even if the building is ugly, even if the tenants are paying low rent right now, you have a safety net. You can spend money to renovate it. That's the value add.
right?
And because your entry basis was so low, you can still make a profit. You're competing against developers who have to charge much higher rents just to break even on their new construction. You have a competitive advantage baked right into your purchase price.
Which brings us perfectly to the second listing in this section, the turnkey option, a 3,560 square foot retail center, brand new 2024 construction.
Right. This is the building the other guy was trying to build from scratch.
It has 2 national regional tenants with long-term NNN leases. It's in a high-growth pocket, but presumably this is selling at or even above replacement cost?
Absolutely. Here, you are not paying for a bargain. You're paying for certainty. You're paying a premium so that you don't have to deal with contractors, you don't have to find tenants, and you don't have to worry about the roof for 20 years because it was installed last week.
It sounds like a personality test.
It really is. The Colleyville buyer wants to create equity through work and problem solving. The buyer of the 2024 center wants to preserve equity and generate cash flow immediately. One is an entrepreneur, the other is an investor. And the market needs both.
I like that distinction. Now let's get into the weird stuff. Section 3, the wild cards. These are in the $2 to $5 million range, and they really break the mold. The first one is just dirt.
All dirt.
Yeah, 37.8 acres of residential land. The seller is the Cedar Hill Independent School District, CHISD, but the part that feels like a movie plot is the format, sealed bid opportunity.
This changes the psychology completely.
Explain the game theory here. In a normal deal, I offer $1 million, you counter at $2 million, we settle at 1.5, we talk, we negotiate. How does a sealed bid work?
In a sealed bid, you have one shot. There's a deadline. You submit your number in a sealed envelope or, a secure digital portal these days.
Right.
And you have no idea who else is bidding or what they're offering. You're bidding in a total vacuum.
So you're bidding against ghosts.
You're bidding against your own fear. If you bid too low, you lose the deal, and you might have spent weeks analyzing it. If you bid too high, you suffer from the winner's curse. You won, but you overpaid, and now your profit margin is gone.
So how does a developer even come up with a number? They can't just guess.
They do what's called a residual land value analysis. They work backward.
Okay.
They say, okay, on 38 acres, I can build, say, 150 homes. In 2028, those homes will probably sell for $500,000 each. They calculate the total revenue, then they subtract the cost of roads, pipes, construction, marketing, and the required profit margin. Whatever's left over the residue is the absolute maximum amount they can pay for the land today.
That sounds incredibly rigid.
It has to be, especially with the school district as the seller. They're bound by public sector rules. They can't just pick the person they like. They usually have to pick the highest qualified number.
Yeah.
It is the purest form of price discovery. There's no schmoozing.
Okay, the other wild card in this section takes us out of Texas entirely. A 10,000 square foot single-tenant retail building in the Oklahoma City MSA. Why are we looking at Oklahoma in a Texas-heavy list?
We're chasing yield.
Define that for us.
The listing highlights a 7.25% cap rate. Now, the cap rate is your annual return on cash if you bought the property outright.
Yeah.
In prime Dallas markets like Frisco or Plano everyone wants to buy, there's so much money chasing deals that it drives prices up.
And that drives the yield down.
Exactly. It drives the cap rate down. You might only get a 5% return in Dallas because it's considered safe and hot.
So to get a 7.25% return, you have to go where there's less competition.
Precisely. You trade geography for yield. You go to Oklahoma City. The listing notes a brand new 10-year lease with a corporate guarantee. So the tenant quality is high, the building is low maintenance, but because it's not in a Tier 1 coastal or massive metro market, you get a better interest rate on your money.
It's strictly a financial instrument at that point. You probably aren't driving to OKC to inspect the landscaping every week.
If you're driving to OKC to inspect the landscaping on an NNN investment, you bought the wrong investment. You bought yourself a job. The whole point of this asset is passivity.
Fair point. All right, Section 4. The heavy hitters, $5 to $10 million. These are institutional-grade assets. And the first one is a fascinating hedge against the economy. It's a state-leased assets portfolio.
This is the ultimate sleep-well-at-night investment.
The tenant is the state of Texas. These are build-to-suit government facilities in Houston and Dallas suburbs. But the bullet point that really stood out to me, and I want you to unpack this, is CPI-based annual increases.
That is the golden ticket.
Why is that so rare? And why is it so valuable?
Most commercial leases have fixed bumps. Lease as rent goes up, say, 10% every 5 years, or maybe 2% a year flat.
Okay.
And that's fine when inflation's at 2%. But we all remember when inflation hit 7, 8, 9% recently.
Of course.
If your rent only goes up 2%, but the value of the dollar drops by 8%, you're losing money in real terms. Your purchasing power is just evaporating.
Your asset is withering away.
Exactly. A lease tied to the CPI, the Consumer Price Index, means your rent rises in lockstep with inflation. It's a perfect hedge. If inflation spikes, your income spikes.
Wow.
And you combine that with the state of Texas guarantee. This is arguably safer than corporate bonds. It's a sovereign-backed inflation shield. And it's rare because tenants hate signing them. They don't want that unlimited risk. But the state will often do it to secure specific custom-built facilities.
Next up, we have the big box. A 50,230 square foot single-tenant retail building. The tenant is Dick's Sporting Goods.
Classic power center anchor.
It mentions a recent lease extension, which is good, but I look at a 50,000 square foot building and I see risk. If Dick's decides to close this store, what do you do with a 50,000 square foot windowless box? You can't exactly turn it into a dentist's office.
That's the dark value risk.
Yeah.
Releasing a space that size is incredibly difficult. You can't just put a coffee shop in there. You need another massive retailer, or you have to chop it up, which costs millions in construction.
So why take that risk? Why would anyone buy this?
Because of the lease extension. That's the signal.
Yeah.
Dick's Sporting Goods has sophisticated data. They know exactly how many baseball bats and sneakers they sold at this specific location. They know the demographics better than the landlord does. The fact that they extended the lease means this store is profitable. You're basically pivoting off their internal data. And usually the yield on these big boxes is slightly higher to compensate you for that dark value risk we just discussed.
Okay. Finally, in this heavy hitter section, we have a pad site to a 1.2-mile SF super regional mall in Houston.
This is all about synergy and what we call gravity.
The listing says 100% leased with credit-grade tenants. Explain that pad site dynamic. You're small, the mall is huge.
Think of the mall as a massive gravitational well. It pulls millions of cars off the highway. But to get into the mall, those cars have to drive past the pad sites, the smaller buildings on the perimeter, usually right by the road.
You're intercepting the traffic.
Precisely. You get the visibility of the mall without the headache of owning the mall. Malls are complicated. They have interior corridors, massive HVAC systems, security issues. A pad site is simple. It's a strip of stores.
Right.
And notice the listing says brand new 10-year extensions. Just like with Dick's, these tenants are voting with their wallets. They know the mall traffic feeds their business.
Okay, we've arrived at the summit. The trophy asset. This is the 10 million plus category. A 37,772 square foot retail center at El Dorado Parkway and Teal Parkway.
The crown jewel.
It's listed as Sprouts Shadow Anchored. We hear this term shadow anchored a lot. It sounds a little mysterious. Does it mean you're hiding in the shadows?
In a way, yes, but it's a strategic shadow. In this deal, you likely do not own the Sprouts Farmers Market building itself. They probably own their own box or have a separate lease.
Okay.
But your shopping center is physically attached to, or it kind of wraps around, that Sprouts.
So you don't get the rent from Sprouts?
No. And honestly, you might not want it. Grocery stores drive a ton of traffic, but they negotiate very tough, low-margin leases. You don't make a ton of money on the grocer. You make money on the dry cleaner, the nail salon, and the sandwich shop right next door.
Because the people buying groceries at Sprouts go to those shops.
Exactly. Sprouts is the daily needs generator. People go there 3-4 times a week. You are drafting off their foot traffic. You get the benefit of the anchor without the cost of the anchor. That's why it's called shadow anchored. You're basking in their traffic shadowing.
And listing it as a trophy asset implies this is about more than just cash flow.
It is about wealth preservation. It's 2016 construction, so it's modern. It's in a very affluent location. Institutional funds or, ultra-high net worth families buy these not to get rich quick, but to ensure they stay rich. They want an asset that will likely never be vacant and will appreciate over 20 years. It's a legacy play. It's something you pass down to your kids.
It really is incredible to see the spectrum here. We started with a 700 square foot office in West Plano that costs less than some condos, and we ended with a $10 million plus trophy center.
And don't forget the school district land and the government inflation hedges in between.
It just clarifies that commercial real estate isn't one single thing.
Not at all. It's a menu. If you want mailbox money, you buy the NNN lease. If you want to sweat for equity, you buy that value-add Colleyville Center.
Right.
If you want to gamble on your development skills, you bid on the land. There is a specific vehicle for every risk profile and every goal.
And we should mention, this deep dive was fueled by the listings from Eureka Business Group in Plano, Texas. Joseph Goslan and his team have been navigating these waters since 2008.
And their approach here, providing this level of detail on the why behind the deal, is really valuable. It shows they aren't just flinging flyers. They're analyzing the business case for the investor, whether that investor is a first-timer or a fund manager.
So as we wrap up, I want to leave you with the thought. We spend so much time online hearing about the retail apocalypse. The narrative is that Amazon is eating the world, physical stores are dead, and we're all just going to live in the metaverse.
It's a very loud narrative. If you only read the headlines, you'd believe it.
But look at this list. Look at where the smart money is actually going. Investors are fighting via sealed bids for land to build homes. Dick's Sporting Goods is locking in physical locations for the next decade. Private equity is paying millions for shadow-anchored centers just to be near a grocery store.
It doesn't look like a dying industry when you look at the checkbooks.
Exactly. Perhaps the death of physical retail has been greatly exaggerated. Humans still need to go places. We still need to see things. And most importantly, we still need to buy things in the real world. The people writing the biggest checks seem to be betting that isn't going to change anytime soon.
Something to chew on the next time you drive past a strip mall and wonder who owned it.
Thanks for listening to The Deep Dive. We'll catch you on the next one.